Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Well, today's our favorite day, the Primary Vision Frac Spread Count, where we get to go over some U.S. activity. And on today's show, we're just going to do U.S. activity, some of the impacts from India, and what does that mean for the physical market overall. And then we're going to go a little bit into some of the Chinese data that came out and the U.S. GDP. But again, this is going to be high level, and we'll do a deeper dive next week in the econ show, and again in the EIA show. So today we had another small drop of 5. So we came to 212 after last week's 217. And this is what we were saying. And we have an article coming out in the OAGR magazine where we've been talking about how 220 was going to be that near-term top. And not to say that we're going to get this big move down, but we're continuing to see just right now, just like looking at some of the data points. We had Denver backing off a touch. We had Permian backing off a touch. And remember, this number is the active spreads. So just to give you an idea, so the Permian fell by 3. It doesn't mean that 3 spreads went away and are going to go into warm storage. It just means that they're just moving to another site. And this is what we're trying to give you, some real-time indications as to what is happening with actual activity in the market. And as we said, when the 220 number came out, which again surprised me as well as some of the others in the company, it was that we had a lot of the smaller basins come on all at once, and now we're starting to see some of those come off just a bit. But again, we're still going to go back above 220. It's just this is going to be that digestion period as we go into May. And then when we get into May, then we'll start to see that normal kind of acceleration, which typically peaks on a seasonal level. We normally peak around mid-July. Now, that's something that, based on what we're seeing right now, we had that run into as spring progresses, digestion, and then as we, digesting the situation, and then going into the summer months. Now, before we move on to the next slide, we just wanted to touch on, so Vital is now in the shale game with their purchase of Hunt Oil in the Permian Basin. So the deal is about 44,000 acres across 5 areas, 5 counties in the Midland Basin, which has, if you're thinking about where you'd enter, the Midland has a little bit better crude just based on quality. Now, not to say that the Delaware isn't good. It's just that it's a little bit lighter. Splitters have to be involved, and if you want to get to a certain grade. And just based on what the price is, the estimates initially were for about a little over $1 billion. And no one really knows what the final price was, but we're starting to see some movement. And Hunt Oil is the biggest independent, one of the larger ones that is left at this point in terms of the private side. And we continue to see some of these shifts happening in the market in general. But just to kind of put some of the context on that, on the moves in the frac spread count, because we've seen that activity on the private side, we're going to continue to see some of this activity in general. But this is what we saw, and that's that 206 to 220. That big pop up was where we had some of that spring activity getting pulled forward. Typically, especially on the smaller basin. So that's where, again, that move up, slow grind, and now we sit within this level before we continue to go higher. And when we look at just, looking at the frac spread count, just versus 2020, obviously we're back at that point. But one of the things that we highlight in the article and the reports that we've come out, after we hit that 45 back in, the middle of May, we had that slow grind up, and then we hit that acceleration point in October. And we really maintained some of that, stronger rate of change. Obviously, we had the Texas freeze off, which put us down. But, within a very short period of time, we not only increased, but blew through that number as we got that acceleration, obviously aided by crude pricing. Now, when we think about, okay, well, what happens next in the U.S., we like to look abroad and understand what are some of the opportunities. And when we look at global refining, you can see that we, typically we have our normal turnaround season, which is coming to an end or starts to end now and into, let's call it the middle of May. And the bigger issue at this point is going to be what happens with the floating market and the export market, given the issues within India. And when we look at India in general, we have to understand, okay, well, what are some of the other areas doing? So the JBC came out and said OPEC's output increased 65,000 barrels a day in April to 25.3 million barrels. And it was really driven by Iran bringing on another 100,000 barrels. And we saw some of that impacting Chinese purchases because we saw China purchasing a bit less from West Africa and some parts of the Middle East as they were taking down more Iranian crude. And now this is something that we want to look at, especially when we consider what's going to happen with India. So when we look at the floating numbers, and again, we'll do this again for, provide an update in the EIA show, specifically segment 3. But what we're seeing so far, and the early estimates, is that India is going to see a decline of about 900,000 barrels a day to as high as 3 million barrels a day on oil imports. And the reason why we have such a wide divergence of expectations that is in the market, and then we'll give you what we're expecting or what we're seeing so far, is because they are near peak oil storage. So there's really nowhere to put this crude. And we've had a big step down in refined product demand, which is going to leave product in the tanks, which, again, if a refiner can't take oil and then store the product somewhere, they're either going to have to cut runs and try to manage the system, export more. So we're already expecting a increase in refined product exports to try to get some of the residual out, just because a refiner, as we said during and we were trying to help explain during COVID, a refiner has to maintain a certain pressure level. So you can't just say, I'm just going to flip off a couple switches and we're going to go from running 80% utilization to 30. That's not how it works. If the pressure pipes need to be maintained, they need a certain amount of pressure, they need a certain amount of product to make the process work. So typically you come to a point, and it varies depending on the refiner, of about 60 to 65%. So if you're going to go below that, you're going to be shutting down either specific units, specific trains, or the whole refiner. So that's why there has to be that management, which is what we're going to see with an increase in exports. And we're starting to see some of that come through with some deals and some flows heading into Europe, which we'll talk about. But right now we're seeing about a cut of between about 1.3 to 1.5 million barrels a day of imports into India. Now that could accelerate, and by the decline, right now we're starting to see some reoffers, but we're floating storage, as we said in the EIA show, is becoming the favored move. They're trying to defer what they can, but that's going to be the near-term decline in imports. So right now we're seeing that stack up a bit on the coast. But as this accelerates, we expect to see some reoffers and some pressure on pricing. And the reason why we have this confidence now is some of the new data that's come out specifically on West African crude. And India, remember, was one of the big buyers of Nigeria when you look at what they've moved off the system. So just touching on one thing before we go through Angola, Nigeria, and some of the West African grades, we just want to touch on what is happening with a pretty deep maintenance season that's coming back through. So we had a small one in Norway, which saw the drop, and now we have a bigger one in the North Sea, impacting Fortes and things that make up dated Brent. So when we consider what has happened in the UK with that 120,000 for June, that's factoring in some of that drop. Now, Troll is at a new record out of Norway, so we're getting a little bit extra out of Norway, but again, the UK is going to see that drop through June. It's going to be I think it's one of the lowest in 15 years. So that, again, that's going to be something to watch. But the maintenance is known. It's just something to consider when we're looking at some of the pricing. As we see, Congo has increased, and then and we've started to see some deferrals because some deferrals happened in May into June, and we've had the same thing with West Africa. Now, getting back to West Africa, and then we'll touch on Russia. So when we look at Angola, so crude differentials fell between 50 cents to $1 below dated Brent. But when we think about that in terms of parity, that's either at parity with dated Brent or $2 less. And it's depending on the grade. And that's where we're starting to see some of these headwinds going into China, because China is seeing that there's more availability with India pulling less. And so not to be surprised that China is buying weakened for Angolan shipments in May as the nation was looking to work through inventory, which we'll talk about, and running some of those additional Iranian crudes. Now, Nigeria, on the other hand, saw a bit of a bigger drop versus some of their grades where they were down 60 cents to $1 per barrel. But then when you look at some of the OSPs, it's actually down $1.19 to $1.02, depending on some of the movements. Now, this is a bit of a different side because prices were weak for sales into Europe, which we already know about in terms of those European moves. But we're also seeing pressure with India just essentially coming to an all stop and on what they're going to be running at this point in time. So that's going to be a bigger issue going forward, which is when we turn to Urals. So when we look at Russia, Russia's putting out a 13-month high in terms of Urals into the market. And last month they didn't sell any into Asia, and now we're starting to see one or two get sold, but it's still really light, which is going to be a problem when you consider what is going to happen with India, because typically India does take down some of that product, and we're just not going to see that at least through the next 2 weeks. And just based on the way the numbers look coming out of India, it will be a bit longer. So that's going to become a bigger issue. Now, headline just came out, which we talked about on the EIA show, where Texas Gulf Coast processed the lightest crude slate in 36 years. And you have to think about what is that going to look like? And that's why when we were talking about imports into the U.S. versus storage, they're going to try to use some of this storage. And especially when you think about what they're making, they're going to try to optimize the lighter end and the processes that require the lightest crude to try to target the upper end of the stack, both the gasoline and the octane side, because that is where we're seeing some of the best margin, or where some of that growth can come into. So that's going to be something to watch in general. But when we think about China, and it's important to consider it right now because their May holiday kicks off May 1st, and then it goes, I believe, until May 5th, or I think it's Wednesday of next week. So this is going to be, and just to give you an idea, and we'll touch on what that looks like, we're already seeing a pretty healthy movement as people get back into activity. But at the same time, we have Chinese Shandong stocks at 4-week highs. But you can see, even though it's a 4-week high, it's by a small amount. I mean, we're still working kind of at that top of the range, but they're going to try to manage the system, and this is going to be between China and India as moving things around, as European imports of clean petroleum product or clean products in general from India rose to their highest in more than a year in April, with more to come behind it as they tried to move product. European imports of oil products from the Middle East, mostly middle distillate, more than doubled in April, with a sharp increase into the UK and Italy. 27 tankers hauling 1.84 million tons of Middle East refined fuels will arrive in Europe this month. So when we're looking at the flows, because again, they leave in April, show up in May, depending on where they're going, what route they're taking, could be early June. But we're starting to see some of these movements, which is why we talked about Fujairah, and we're going to talk about Singapore for a minute to see where some of those flows are going. And then when we look at China, speaking to what are they getting ready for, so the fuel oil stocks in Shandong are at a 2021 high, and it's, as you can see, the seasonally adjusted high. But when we look at what's happening for their Labor Day, so tickets for everything from domestic flights to theme parks, everything have sold out. So we are seeing some movements, bookings for seats on planes, hotel rooms, car rentals over the five-day break are surpassing those from the same period in 2019. And people will make an estimated 200 million overall trips, which is going to be a record for this point in time in terms of some of the deals that are happening. Now, there has been some cost cutting to do that. So when we look at the revenue side, but this will be a net positive. So we want to see how is this going to impact some of the storage, because we're seeing that there's a lot of storage in there, and their margins have been pretty good internally. So we shouldn't see too much go abroad, but that could change depending on what's happening, because right now India is going to really try to saturate that market. And when we look at what has happened in the in the level, some of these levels, you can see that there was a pretty big drawdown in Singapore, still along seasonal lines, whereas seasonally we normally have this drawdown. But it was really driven by that light distillate, which is going to be one to watch as to does India try to backfill into this, because resid, which is something that we saw in Fujairah, actually still remained fairly elevated. And then when we look at Europe, we had builds across the board, which was driven by slowing demand, imports, and then the Rhine River impacted that because it's at a fairly low point, so they had to cut movements, which is going to leave more in the system. And then we also had some of the negative, some fluctuating data, which we talked about in the econ show. Now, just putting into perspective on the Singapore side, typically on the 5-year average, we typically get a drawdown at this point. Looking at it against the 13 years, you can see that we're still at those highs. But this is going to be one to watch because we expect some backfill from Europe. And just picking on gasoline here, because in Europe it still remains at a near seasonally adjusted high, even though on a 13-year average we typically get a pretty steady decline, as you can think of, through spring as people get back into action. But we're just not seeing that this year, which again there's still lockdowns. There's still some of that friction, which is going to remain. So we assume that this is going to stay fairly elevated, and we should see additional exports coming into the U.S. It won't be at the record-breaking or seasonal breaking numbers, but it'll still be at a healthy dose. So then when we turn over to China for a second, we just wanted to touch on some of the PMIs, because we're getting some contradictory information depending on who you're looking at. So non-manufacturing PMI, the official came in below estimates. The expectation was for 56.1, came in at 54.9. Manufacturing was expected at 51.8, came in at 51.1. And these were the expectations we had, that we were going to get some slowing, especially on the non-manufacturing side. And on the manufacturing side, when we look at credit impulses, which we did a whole show on, which came out on Thursday, looking at debt levels and credit impulses. But then on the Caxton Chinese PMI manufacturing, expectations were for 50.9, and they came in at 51.9. So that's a bit more consistent with the World Economics SMI trend. And we keep talking about this, we think that it's somewhere in the middle where we're getting some slowdowns. And again, we're going to get a seasonal bump for Labor Day, but the manufacturing side will continue to be under pressure because where China's losing some of their export capacity. And again, it's not detrimental, but we're seeing it pick up. Like South Korea had some very good manufacturing data. Japan's seeing some of that recovery, and we're seeing some of those movements. So then when we look at it just on a chart level, you can see that it's essentially flatlined, and the manufacturing PMI is normalized closer to kind of a steady state level, where we're getting some things going up, some things coming down. And we think that just based on the credit data and the impulses, that the move is going to be to the downside and is going to work its way closer to 50. Now, shifting to the U.S., just looking at the GDP growth, when we look at the year over year and the shortfalls in general. So when we look at the year over year, we're at 0.4%. Annualized, it was a fairly strong number at 6.4%. But we have to consider what's making that up, because a large part of it was driven based on some of the stimulus. So when we break this out a bit, in general, so nominal GDP was up 554 billion in Q1, and the same quarter that government transferred 2.25 trillion. So the problem could be said that, well, we're putting all this money in, but what are we getting on the back end? And so when we think about the index quarter over quarter of 4.1%, but now the problem that we're seeing in terms of what is discussed as a better metric for the price index. So that's why when we look at the price index, which is what is the real GDP? So price index, the GDP price index is viewed as the best way to measure inflation. This is Fed's terms, not ours, but we do agree. And you can see that it blew through estimates and came in at 4.1%. So this is saying that inflation or inflationary numbers came in at 4.1% in Q1, which is clearly well above 2%, well above CPI, and is much closer to what we've been harping on constantly in our econ shows. And then when you look at personal consumption core price, you can see that it had a move to 2.3%, which was right around estimates. But the biggest one to watch is going to be this core, this GDP price index, because I mean, prices didn't go down in April. And as we look at some of the Chicago numbers, and the PMI data, it's only going up, where we have record-breaking moves in a lot of this. And then just touching on unemployment benefits, we did get a small decline. Even though continuing went up, we did get a decline in initial claims. We had less of a decline versus estimates, but again, still moving in the right direction. And then when we look at it from the aggregate side, as in terms of the weekly data and what factoring the pandemic emergency, you can see that we're still at about 16.6 million people that are receiving some form of benefit. So again, those are things to watch as we come into and look at what is going to happen with stimulus, what is going to happen with economic growth. And this could be, we think is going to continue to be some of those overhangs. So again, this is kind of the high level. We'll go into more depth when we go into the econ show, specifically on this, and then on the EIA show when we look at what is happening throughout the commodity universe, specifically oil and refined products. If you have any questions, we always love the back and forth on Twitter, LinkedIn, or by email, or in the comments section of YouTube. So again, thanks again for watching. We hope you have a great weekend. And I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.